Hello, everybody. Today we are going to talk about uranium and nuclear energy, also where to put the smart money in this sector. And I cannot think of anyone better for this topic than our guest today, Scott Melby. Scott, thank you for coming today to the show. How are you?
Oh, great, Luis. It's always a pleasure to go on your show and lots of exciting developments to talk about.
Well, yeah, it's very exciting times, as you said. A very hot market, the uranium sector, as we sit in today. Spot prices approaching 60 pounds, $60 per pound. Well, to break the ice a little bit, what's your overall take on the market? And we can move from here.
Yeah, no, it's a good time to talk about uranium and uranium equities because the general broader market, even though some specific tech companies have been pushing the indexes up on the Nasdaq, for example. I mean, there has been kind of a broader risk-off sentiment, and the market's been very skittish towards any sort of news. And I think the uranium equities have been held back by that. But if you are a long time persevering uranium investor, you should be very encouraged that the fundamentals as they sit today have never been better. And that's with the perspective of 40 years of uranium and nuclear energy experience. We knew the market was oversupplied after Fukushima. We knew producers were continuing to produce into hedged contracts. And, we knew that by 2017, that production discipline needed to kick in. And now, over that period of time, we've had, several years of a very significant gap between global consumption around 195 million pounds and production, which has been in the 130, 140 million pounds. So the drawdown, the gap between those two figures represents the huge drawdown of secondary supplies and inventories. And the market was rebalancing on that basis, on the supplier discipline alone in Canada, the US, Africa, Australia. And then we've spoken on your show about Sprott Physical Uranium Trust and the impact that they and other financial speculators, investors have had in pretty much vacuuming up the remaining excess supplies from the market. So as we sit in 2023, I can confidently tell you that the market has now rebalanced, past tense. The excess inventories that were overhanging the market are now gone. That's a bold statement because it's been the case for many years, if not decades, that we've been in a inventory-driven market, and that's difficult for price formation when the marginal pound to supply demand is coming from an inventory source, not a produced source. So now, as we go forward, the marginal pound to supply the market is going to come from a produced pound. And that means cost of production, availability of production, ramp up of idle mines, all those things that a normal commodity would react to are now going to be governing the uranium price and market going forward. And so it's not surprising. Uranium price has been trading in the $56, $57 range, still not at I would say the incentive price for even the best producers in the world. And I think UEC is not the biggest producer in the world, but its threshold for restarting production is in the $60 range. So, but most big mines needing big capital lifts need a lot higher prices than that. So we could have the uranium price run considerably here and not have a big influx of supply and new production like you would have in, say, copper or gold or other more mature markets. So it's that alone is driving the uranium price upwards. But then you layer on things like geopolitical risks in Russia and Ukraine, and it really gets the narrative gets really interesting.
Exactly. Well, that was a really nice introduction. I saw, well, for everyone to kind of understand, it's like the commodity prices move for supply and demand, and the supply is somewhere like 130 and the demand is 195, right? Something like of that sort. So all that uranium comes from, well, used to come from secondary market, and now that marginal pound is going to come from producers that they will command at higher prices. No, that's why the spot price is tending higher. I saw just preparing for this interview, one of your colleagues, Amir Amnani, the CEO at Uranium Corp, Uranium UEC, Uranium Energy Corp. He said that the 60 pound range, it can very quick clear out to the 100 level. That's because, you know, as you said, some speculators like Sprott, Yellow K, new entrants like Suri Invest are also producers of uranium are buying the metal itself, but as well utilities are now starting to come in this market. Can you give us a sense of where the demand? Do you see where the demand's coming from and how that's going to affect the uranium?
Yeah, no, it's true. You know, we've seen prices increase in recent months without the participation of Sprott. You know, they've been trading at a discount to NAV for, you know, a couple of months now at least. And so, you know, any sort of incremental demand that comes into the market seems to push the price up, you know, $1 or $2 a pound. And a good example of that was Pacific Gas and Electric with the Diablo Canyon nuclear plant in California that Governor Newsom wanted to shut down for years, fighting to shut that plant down, and now is scrambling to try to keep that plant going. And, you know, they've gotten another lease on life here, another 5 years or so at least, operations, but they had no uranium contracts in place. So they had to come to the market and buy uranium conversion and enrichment, all in sort of an emergency last minute approach, which, you know, has impacted the market. You mentioned Zuri Invest, a new fund with $100 million to buy physical uranium, more an open-ended fund as opposed to a closed-end fund like Sprott. But these all have.
What's the difference? Sorry, between
a closed-end fund like Sprott buys uranium and warehouses it, and it doesn't come back out. Zuri Invest, I think, is meant to be as people buy shares in that fund, they buy more uranium, and when people redeem shares, they sell uranium. So it's not as lasting lockup as Sprott is, but it has significant impact, you know, in the current market. And, you know, other things that are driving utilities' thoughts is, you know, the threat of Russian sanctions. You know, we still don't have a ban on Russian uranium in the United States, but we do have bills that have passed through committee in the House and the Senate that would ban Russian uranium and have some different measures of revitalization of domestic uranium conversion and enrichment. You know, 50% of uranium supplies in the United States come from Russia, Kazakhstan, and Uzbekistan. Any sort of restrictions there, either voluntary by utilities, which we're definitely beginning to see, or mandated through sanctions or bans, you know, obviously throws additional kind of emergency buying into the market. And I think, you know, whether there's a ban or not, I think we have to talk about Kazakhstan because it's the largest producer in the world today. It surpassed Canada with about 40% of global production. But in a world where, you know, Russia is increasingly isolated, they control half the uranium production in Kazakhstan and desperately need that for their reactors in Russia and their client states like Belarus, Turkey, India, Iran. And so, you know, they need that share of uranium coming, you know, to Russia. They don't want to see anything that would, you know, the talk of having supplies open up, you know, to the west from Kazakhstan is not in Russian interest. So, you know, look for them to frustrate some of those developments. China, on the other border, is increasing their ownership in mines and JVs in the country. They're signing very large contracts, huge contracts with the Kazakh joint ventures, you know, to feed their growing nuclear program. So the takeaway from that is the very large uranium producing country that is Kazakhstan may not be that available for us, even if some of these routes through the Black Sea and Armenia and Georgia, you know, can be perfected. I'm not sure much of that uranium makes it to the West. So again, that puts pressure on mines in Canada, the United States, Australia that aren't under Russian or Chinese control to ramp up to help meet Western demand. So that's very good for Uranium Energy Corp with mines in Texas and Wyoming that are, ready restart mines, and for Uranium Royalty, where, we're actively, we have a number of mines in the portfolio now that are restarting production, and we'll start to see cash flow from them in 2023. But we also, think that additional investments in these various jurisdictions, will help grow our portfolio at URC.
Exactly. Well, actually, you touched a really nice point. There was the Chinese agreement with Kazatomprom. They were securing, let's say, the uranium they will need for that electrification of China. Also, Cameco is contract some of the uranium. So, and then there's the US, right? That they put a plan of 1.5 billion, if my memory serves me correct, to secure that uranium. How is that going? Because I saw the news that 1 million pounds were purchased. UEC, I think it was the biggest off taker with 300 pounds in that agreement. So my question is, how is the US preparing for that implication? It may come after the summer, the ban on Russia. It can be voluntary by utilities. How do you see? Because from my point of view, and this is just like a speculation, and I want your opinion as an expert, is it possible? Do you see any scenario that the pounds, depending of location, has a different market, different premium? For example, in oil, we have the different types of oil, depends on where it comes. Do you see any scenario where this can happen?
Yeah, I think, excuse me, I think we're heading in that direction already. Well, you saw the Strategic Uranium Reserve tender for £1 million that was awarded late last year and delivered earlier this year. UEC was a participant in that. There was a significant premium paid for US origin uranium, but that's just a kind of one example. But indeed, if if Kazakh supplies are not available to the West and new mine development is required in Canada, the United States, Australia, I could see a two-tiered market developing where a premium is placed on supplies that are secure supplies from good jurisdictions. And I think the United States and Canada really are at the top of the list when it comes to stability and predictability. Cameco has seen huge contracting success as the largest Western producer, but so much so that I think they're getting to a point where they're nearing fully committing near-term production. I mean, just their contract with the Ukrainians over 12 years committed something like 18-19% of their tier one production in those years, and they followed on with contracts in all the market regions. So even the producers, the so-called tier one producers that have production available, many of them are getting fully committed. And so it's now causing utilities to look at the next tier of producers, which is a whole array of smaller restart companies like UEC, or new mine developments like you might have with Global Atomic in Africa. But you look at the universe of mines that can restart quickly or start up quickly, and it's quite limited. These aren't huge mines. They're very welcome to the market, and they're really seeing success in terms of contracting right now. But we need probably 8 to 10 new mines coming online globally between now and 2030, and it's not easy to see where all that supply is going to come from.
Exactly. And I want to come back to USC and your company that you're involved with, Royalty Corp, a little bit later. So to play, if investors want to play this market, but I think, and we touched a little bit before the camera went on, is the green energy movement towards the electrification of the world. I think that's one of the biggest plays right now coming from the demand sector. That is the growth of the nuclear sector. In the past, it was China. Now you are seeing, and I saw a picture of you with Boris Johnson, and you visit the Rolls Royce. The small modular reactors coming from the UK by Rolls-Royce, or you see coming in Wyoming by Bill Gates, the TerraPowers of the world. Where do you see a real demand coming from this part, and how do you see? Can you give us any picture about this topic?
Yeah, well, it's you know, it's something new for the uranium market observer, because you know, uranium demand had been very predictable, you know, at times been declining after Fukushima, where you know, we were expecting countries to reduce their reliance on nuclear or move away altogether. You know, at the end of the day now, I think really only Germany, you know, has followed through. I think Spain is in that group as well, but I've seen some of your political parties saying that, hey, let's slow down. Maybe we shouldn't move away from nuclear even in Spain. But most countries like Sweden, Belgium, Korea, France, everyone is saying, no, we're going with more nuclear, not less. And it's really as a result of the failure of the green transition in terms of decarbonization really has failed, you know, trying to be an all renewable story. Renewables can only go so far. I mean, if they run 25, 30% of the time, we have to figure out how to deliver baseload energy for the other 70%. And that's where nuclear comes in. It's the math and science to counter the more ideological approaches. So we are seeing, you know, the demand line now increasing, and that's something we've never seen. But quarter over quarter, we get more and more optimistic scenarios for nuclear growth, which translates into uranium demand. And the small modular reactors we've really only just scratched the surface there, because the first of a kind units like the Rolls-Royce in UK, TerraPower in Wyoming, NuScale in Idaho, X Energy in Texas, GE Hitachi in Ontario, Canada, we're just seeing the first of a kind units being built to come online between now and 2030. And they're coming with really strong government, public-private support in terms of financing. But as those are successfully deployed, I see hundreds, if not thousands, of these ordered in the 2030 to 2040 timeframe. And so now, you know, uranium demand isn't 195 million pounds per year. You know, it's significantly more. So this deficit that we're already in, we're in a structural deficit today just with the growth of large reactors. As we see demand taking off, that gap gets even bigger. And that's where the market gets very interesting. I mean, we think of uranium prices at, you know, $56, $57 a pound. Well, there's nothing magical about that level, and it may need prices significantly higher, you know, $100 plus a pound to stimulate the kind of production. And I think you'll have a bit of a rush on resources where if you're building these reactors, you're not going to want to be left without fuel supplies. And we could see, you know, similar to what we have in lithium, where GM, Ford, the auto manufacturers are now investing directly in lithium mines around the world. I know this was a feature of our industry years ago, but I see scenarios where that could come back. I see scenarios where oil and gas companies become significant players again in the uranium market, like they were in the 1970s at the time of the Arab oil embargo. So exciting times. It's going to need a lot of uranium. New mines developed. UEC is in great position with mines in Texas and Wyoming. We've been taking active steps to de-risk not de-risk, but actually move forward with the restart preparations at Christensen Ranch. Everything from testing the existing well fields, pumps, valves, header houses, everything that we need to do to restart existing well fields, which really require very little capital. It's just restart of well fields that were shut in 2018 when Uranium One, you know, did the same thing as all the other producers and cut back production. We're also investing in the subsequent well fields at Christensen Ranch, so we not only can start up within, say, 6 months time period, but also continue to advance into future production well fields and sustain production going forward. So exciting times, and Texas has a similar story, maybe not as immediate as our Wyoming restart, but within, you know, 6 months to a year. Burke Hollow's initial production area 1 and production area 2 that we're completing now, can be brought into production as well. So we could be producing on 2 fronts in Texas and Wyoming.
Exactly. Well, for everyone to be on the same page, it's the third time that Scott comes to the show. Watch. I aim to the listeners to watch the 2 interviews that we made. The company that we are talking is Uranium Energy Corp. I'm just going to put it in a little bit on the screen so everyone is trading on the NYSE at the ticker symbol UEC. And yeah, this is a company that is going to produce when you have said publicly when the prices rise for a quarter or 2 quarters above 65 pounds dollars per pound, you can come into production very quickly as no one else can. This is going to be a probably 1 million pounds producing, then ramp up from that. You also purchase, well, you've been very busy this year purchasing almost 600 million US dollars into other companies. Maybe we can talk a little bit that. I want to mention the Rough Rider project because you hold it in UEC and Uranium Royalty Corp. Maybe we can touch a little bit of that project because in the past, this was a really interesting project, right?
Yeah, no, it's an acquisition that UEC made in the last 18 months. You're correct that we've added about 600 million in asset value there just from 3 acquisitions: Uranium 1 in Wyoming, and then UEX and Rough Rider in Saskatchewan. And the Saskatchewan investments are part of our pipeline of production. We want to have near-term production and cash flow coming from Texas and Wyoming, and at the same time be developing what we have now is a critical mass of production potential in the Eastern Athabasca Basin. So Rough Rider at 50 million pounds, 60 million pounds at 0.4, 0.5 or 5%, sorry, 4-5% ore grades represents what can be a standalone project. And Rio Tinto spent over $100-200 million in evaluating the mine plans there, but just had too many distractions with iron ore and lithium and in a global company like that. So we were able to acquire that for $140 million when it was last sold to Rio Tinto at over $600 million. So now with that asset in the vicinity of other holdings like Christie Lake, Horseshoe Raven, we're putting together an economic study on a potential mine and mill complex for these various deposits, which are in close proximity. They're also, convenient location to existing milling capacity, that could tie in one shape or form there. But, we need to evaluate what that looks like in terms of capital cost development. It's not going to be quick, it's 5, 6, 7 years down the road if you started today, but we are taking those early steps to begin preparation to make that ready. We clearly think that, again, the uranium market needs a number of new mines, even over and above. That assumes Cameco and Orano are producing at full capacity in Saskatchewan. It assumes the Kazakhs are producing at 60 million pounds a year. We need other mines coming online in this period. So Rough Rider fits in nicely with that. I'm doubly pleased because Uranium Royalty held a royalty, a 2% NSR on that project that wasn't really seeing a clear pathway to development under Rio Tinto, but now sees kind of a crystallization of that value under UEC.
Exactly. If I'm understood you correctly, you are going to work on a PEA for Rough Rider and the two other deposit.
Yeah, we should see that by August, probably October of this year. We should have that completed. So that'll be a nice milestone to look towards in the early fall.
For sure, to show investors the value that this project standalone it has. Well, something that I wanted to cover and you touched before camera, it was the price to NAV I don't know if you have the numbers in your top of your head.
Yeah.
What are the price to NAV and what's the valuation right now for Uranium Energy Corp? And why do you believe that investors should have a real deep look into your company?
Yeah, well, I normally don't brag about a low P to NAV, but it's the reality of a lot of the uranium equities right now that have been kind of sold off in a risk off environment. I think only Cameco has kind of held its value as a major cash flowing operating miner. But many of the other companies below them, are all trading, closer to 52-week lows than highs. And UEC has been trading in the 0.5 to 0.6 P to NAV. So has Uranium Royalty Corp, despite all these investments that have been made, despite all the positive fundamentals. And so, I look at it as an opportunity. If it's an entry point for an investor that wants to get into the uranium space, you're able to buy, these quality companies with incredible assets at a fraction of their value today. And even if the UEC just reclaims its previous highs at $6-7 a share, that's quite an increase from today's $3 and $3.25. Same with Uranium Royalty. It was the top royalty company, performing royalty company in the world in 2021, and a top 5 uranium investment, and is now trading down below 0.6 NAV. So P to NAV. So again, you add up the sum of the parts here, and you even look at just the value of those recent acquisitions for UEC. They're probably valued by the analysts at their acquisition price, not the true value that they represent right now. So incredible value. And listen, I think the whole uranium sector is undervalued right now. So I think all the boats are going to rise in this increasing uranium price environment. But I think, as good investors, we should look to the companies that will outperform the pack. And I think clearly you are seeing UEC are two of those, given the assets that we have and the plans we have going forward.
Exactly. And for me, the mining industries, for listeners, that's a lot of optionality is the word when you come to mining. And when you see companies trading at 0.5, 0.6 price to NAV valuation, when usually it's bigger than 1, because the price of uranium has to go up from these levels. So I think it's a very good entry point. And the optionality on UEC, there is a titanium project that I think it doesn't have any value in the market right now, that I believe you are working on that a little bit as well, right?
Yeah, and similarly, we've been working on an economic study there to determine what that titanium project, which is probably not getting any value whatsoever in the analyst valuations on UEC, but is potentially the world's largest undeveloped titanium project, 5 billion tons of titanium resources in a country that has good access to green energy from hydroelectric power, transportation access to the rivers and ports there. So again, what's that worth to someone who's a large consumer of titanium or a producer of titanium that can afford to not have that interest in their portfolio? We'll find out in that study. But I think the one thing investors need to know is we're not looking to pivot to other commodities, even the very attractive battery metals and green energy commodities. We're all uranium all the time. So any value that we can realize on that asset, is going to be plowed back into our uranium activities. And listen, our capital requirements to restart in both Texas and Wyoming and be producing, at 1 to 2 million pounds, going to 4 to 5 million pounds, is under $50 million, which we can clearly cover from our own balance sheet. So this isn't like we have to build a $1.5 billion mine mill complex to get in production. I mean, our initial production from Christensen Ranch is already, built, funded, and is really just a restart of existing infrastructure. So Again, really attractive positioning given where we're at today. Clearly isn't reflected in the current share price, but that lot of upside given that reality.
Okay. And before letting you go, just to maybe if you can answer quick questions, maybe one highlight or some highlights that Uranium Royalty Corp investors should look at in the next, let's say, 12 months, any agreement, anything that's going to happen in your company?
Yeah, well, I don't want to give you forward-looking statements that are misleading in any way, but I can tell you that we're extremely busy with 4 or 5, maybe 6 now files with potential counterparties for royalty and stream arrangements where, now that COVID has ended and we're able to freely travel around the world. I just returned from Australia, meeting with all the potential counterparties in places like Perth and Adelaide. We need to do the same in Africa, and basically coming alongside companies and saying, okay, it looks like you could use 30, 40, 50 million to help advance your production towards production decision or get it over the hump into production. We want to come alongside those developers globally and take a royalty or streaming interest. And for them, it's a very low cost of or competitive cost of capital versus debt and equity right now. So like any royalty company, we need to be a growth platform. Our 18 royalties, we're very proud of the current portfolio, and a number of these are beginning to have restarted production or are restarting production. We'll see cash flow under those, but we really need to grow that, like Franco-Nevada, Wheaton Precious Metals. These royalty companies have grown exponentially, and that's the model we want to follow. So again, we're actively out there trying to make that happen.
Exactly, and something really good is that this is a company that can pretty much last forever. Like no company, mining industry is like a cyclical company. You have top exposure, so the cash flow can live through cycles. So this is a really good company for long-term investor to look at. And before letting you go, Scott, I don't know if you want to answer this question or not. That just depends on you. Where do you see a price coming? You always say, do you believe there is going to be a supply squeeze? Do you see any price target for the coming months, coming time?
Yeah, well, I mean, listen, uranium isn't the most mature commodities, right? Like copper, gold, silver, price signals translate into immediate production increases or production decreases. And so the price of those commodities is more regulated into an equilibrium. Uranium has never traded at its equilibrium price. I mean, you could theoretically say $70 a pound should be a price that producers can produce and consumers can consume, and the market should clear at that level. We've never been. We've either been at $20 a pound for years at a time, way below production costs, or we go way above, $100+ a pound because we can't get the production responses. So again, I see 60 as a very reasonable threshold to breach during the course of the last 6 months of this year. But anyone's guess. I mean, I think you quoted Amir. There's no reason why uranium prices can't go to $100, $150 a pound in this environment if the supply, isn't moderated by inventories or secondary supplies, and production is limited, and much of it is being committed under long-term contract and not available to the spot market. You have all the right ingredients for a significant increase. So my answer is higher.
Okay, it depends for the speculator to take their own bet on the exactly. Higher prices. Well, Scott, it was a lot of fun talking to you. Thank you again the third time for coming to the show.
Yeah, absolutely, Luis. It was a pleasure. Take care.
Take care. Bye-bye.